what our product is with the income share agreement is it says only when you are making money and only when you're making money over a certain threshold are you making payments to us. So when you're making zero or below $40,000 a year building your company, you don't owe any payments.
Hey everyone, this is Prashant and I'll be your host of the VC 10X podcast. And today we have William Stringer with us. William is a co-founder and CEO at Chisos. At Chisos, they are trying to reimagine the traditional VC model. Whenever an innovation like this comes up, especially in the VC landscape, I'm all for it. And this one is particularly extremely interesting and I believe much more founder friendly than the traditional model. In this episode, we learn all about how it works from both the founder perspective and the investor perspective. So without wasting any time, let's dive straight in. Hey, William, so good to have you on the VC 10X podcast. How you doing?
Good. Thanks for having me.
It's my pleasure. And I'm pretty excited about what you're building at Chisos.vc because I don't see new models coming up in the VC ecosystem very often. And that was primarily the reason why I reached out to you and to get you on the podcast and talk about what you're trying to build at Chisos. So can you give us a brief of what you're trying to build and how it's different from what we see normally?
Sure. Yeah. So we are basically trying to build a new funding ecosystem. So today you've got your debt products, you've got your equity products. We're trying to build something different. We're literally trying to build a platform and an investment company that invests directly in people. And so people have a future earning potential as a big asset of theirs, especially if they're younger. And when they go out and try and build a company or pursue their athletic career or start their Twitch or YouTube stream, they need capital. And so that's where we're trying to come in, provide capital by investing directly in people.
That's very interesting. So is that only for small projects or even for people who are making like complete startups, proper companies? So how does the range of that go?
Yeah, it's really everything. And we've really been focused on entrepreneurs so far
Okay.
as we've gotten started.
Right.
And so we've seen a couple different use cases of our capital. Sometimes it is day one. Our max check size right now out of our current fund is $50,000. So on the smaller end, but it does help people get off the ground. It can be, the capital needed to finish development of a minimum viable product.
Right.
It can be capital to bridge to a seed round. But yeah, that it's kind of across the board, and it really just depends on if $50,000 or up to $50,000 makes sense for whatever project or company you're working on.
Right. So you're investing from anywhere between 0 to 50K, right? That's the range, right?
Yeah. 15K is kind of our minimum right now.
Got
so
it.
15 to 50K.
Got it. And just to give our listeners more clarity, who are the kind of people who can apply to get funding from Chisos? Are they
So
entrepreneurs or planning to be entrepreneurs?
right now it's entrepreneurs. So the way we've kind of developed is we're raising or deploying our second fund right now. And that fund is focused on entrepreneurs. So if you are looking to quit your job and build a business, if you're currently building a business, anywhere really in that early entrepreneurial phase, that's who we're looking at. And when we're doing our underwriting, we're looking at both the individual on a couple different levels, including their financial level, including their psychographic level, but then we're also looking at their business. So, sometimes if your business is maybe super early or not even incorporated yet, then we're going to lean heavily on our underwriting of the person. If you do have a business, maybe you have some traction, then maybe your business carries a little more weight than the individual underwriting. So that's kind of the beauty of where we're at right now, investing in entrepreneurs building businesses.
Yeah, that's very interesting. So when you're looking at an individual who hasn't even started their company yet, but plans to start, but there is no proof yet, so you're only focusing on the individual and their individual credibility. So in that credibility, what exactly are you looking at? Their career path and their degrees, their educational background. What are the kind of things you're looking at there?
Yeah, we've got about 15 different things that we're looking at. But the primary factor that we're trying to get to is what is this person's future earning potential? So a kind of strong indicator of a future earning potential is what your previous earnings were And so we are looking at your previous incomes. Sometimes that doesn't tell the whole story though. And so we are looking at what is your career path? Do you have a degree in a specific field? How long have you been working in a field? We're looking at some different references. We're also looking at your credit and your financial picture, make sure that you're not already underwater somewhere. Um, so yeah, we're really just trying to get to what is that future earning potential? What do we think you are going to make going forward uh, in either a success case where your company raises a bunch of money or reaches profitability and grows, or in a failure case, if your company doesn't work out, what is it that you're going to do?
Yeah, got it. And Jesus follows a CISA model for investing. So can you explain and throw more light on that? How does that work? CISA.
Sure. It stands for Convertible Income Share Agreement. Those are the terms that we're investing on into people right now. It basically takes two instruments. One, it takes an income share agreement, which has been used in the education space for a number of years now. And that agreement is directly between the Chisos fund and the individual. And that says when the individual earns a specific amount of income or over a specific amount of income, typically $40,000 a year, or $3,333 in a month, then they share 10% of their income with us until they hit an amount cap or a time cap. So that's the income share agreement, and that's with the individual. That's where we're literally investing in the individual. Now, for entrepreneurs and with our current fund, we combine that with a SAFE or simple agreement for future equity. And with that SAFE, we're essentially targeting a percentage. So we took a Y Combinator SAFE, modified it slightly so that we target a specific percentage, which is anywhere between 0.5% and 4% typically. And so that's the percentage of future equity that the company will issue to us. So when we make an investment, we have really two ways that we'll make money as the investor. One is through the income share agreement. One is potentially through equity. And that's really what allows us to come in with, in the case of an entrepreneur, at day one or even before day one at the earliest stage by investing in that individual.
Yep. Yeah, that's super cool. And I feel that a model like this was very much needed in the industry because a lot of people are not really sure if the thing they're working on will succeed or not, but they still want to try it out, right? And this model, I feel, is perfect for that. That even if it doesn't work out, there is still a way to pay back. And if it does work out, of course, there is a way to pay back, right?
Yeah. I
Yep.
mean, just kind of on that. So when we kind of looked across the landscape of capital options, at the early stage, let's say pre minimum viable product, you're probably not going to raise from angels or especially VCs. You don't have any traction. You kind of need that traction to raise from angels and VCs. Well, you need money often, or if you're technical, put in the time to build a product to get that traction. And so pre-traction, you're usually looking at friends, family, and personal savings money. Well, what if you tap that out? What if there's not a lot of friends, family, personal savings money available? Then what do you do? All right, potential option, max out a credit card, go get a home equity loan, some kind of traditional credit product. Those aren't great because they have fixed costs and compounding interest. And so that's where we came in and created this flexible alternative to uh, provide that capital up front before any traction is available.
Yeah, my next question was on that. How does Chisos compare to the traditional bank loan, right? Because there is of course an interest, but I read on the Chisos website that there is no interest levied on the money given, right? So how does the math work there? How does Chisos make money in that case?
Yeah, so it's kind of have to think about what an interest rate is and the cost of capital and basically a lot of kind of deeper finance questions on how you finance your company or capitalize your company. So if you think about taking money from an angel or a VC, they're looking to return to their own LPs and investors somewhere around 25-30%. Or if they're an angel, they're looking for that 25, 30, even higher percent return. So essentially, that's the cost of capital there if you're taking that kind of money. You're giving up a piece of your company and you're trying to return 20, 30, 40% returns to those investors. On the credit side of things, typically a personal loan, depending on your credit, you're going to get somewhere. Today it's kind of fluctuating, but you call it, I don't know, 6 to 15%. That's the cost of capital for that credit type of product. And what happens with that product typically is you have a fixed payment every single month, no matter what. And as an entrepreneur, you're going to probably go into a period of time where your income is zero or low or unknown. And so when you have a fixed payment monthly and you have unknown income, it's a little bit of a mismatch. And so that's, puts a lot of stress on the entrepreneur. They have to make that payment no matter what. What our product is with the income share agreement is it says only when you are making money and only when you're making money over a certain threshold are you making payments to us. So when you're making zero or below $40,000 a year building your company, you don't owe any payments. And in theory, you could make $39,000 a year for the first 3, 4, 5 years of building your company and make zero payments back to Chisos on the income share agreement. Now, for us as the investor, presumably you're making progress on your company, and so your company is becoming more valuable, and so our equity is becoming more valuable. So that's good for us. That's kind of the things that we thought through to make it a kind of a push and pull, where if your company is doing good, maybe you don't have to make ISA payments. On the flip side, if your company fails and you go back and get a job, then you start making ISA payments. But there is no required monthly payment. There is no compounding interest rate. It's just a fixed sharing percentage of your income until you hit an amount cap, which at the highest is 2x, and can come all the way down to 1x, or a time cap. Typically, we're looking to have individuals pay these off, sometime within 4 or 5 years. Can go up to 120 months of payments is kind of the max time cap that we have on it.
Yeah, that's interesting. And let's talk about some edge cases here. So let's say that there is an entrepreneur whose company isn't working out, and
Mm-hmm.
he has got a job and isn't making up to the threshold. And it's been some
Mm-hmm.
years, right? But you have given money to that person, right? So in that case,
Mm-hmm.
is the money coming back? Is there any way to get that money back for Chisos? How does that work?
Yeah, so that's the risk that we're taking by investing in the person.
Mm-hmm.
If they are making below that threshold, if they make below that threshold for, 10 years, they don't make payments to us
Mm-hmm.
and the contract's complete. That is the risk that we're taking as the investor. So when we're doing our underwriting, we're kind of scaling our investments and looking to probability weight the future earning potential of that individual so that we get paid back.
Mm-hmm.
But
Right.
To that edge case, you fall on real hard times for a long period of time.
Right.
There's no payments that are due, which is what makes this a pretty flexible instrument for people like entrepreneurs or other classes of people pursuing some type of creative endeavor.
Right. Yeah, and I love this, by the way, right? Even though I'm trying to find out how this model cannot work, because isn't common. Like, this is not something that we see very much in the industry. I've interviewed a lot of VCs, a lot of angels, and haven't heard of anything like this. I've heard of ISAs, like you said, in the education space, but ISA in the investing space, investing in a person and then having an ISA agreement with a threshold set, right? That's
Mm-hmm.
very interesting, and I love that, because this is a founder first approach to investing, I believe, uh, a lot more than the traditional approach of investing, wherein, of course, and there is risk in that as well, but in this one, it's a lot more convenient, because and one more question is, like, how do you track these investments? You've invested in this individual, right? And how
Mm-hmm.
will you now track, how are they making progress? Have they started their company yet or not? What are they doing with their lives,
Mm-hmm.
right? So how do you track that?
So we've got a few different ways that we're kind of tracking and staying up to date. So one is we're just on a quarterly basis reaching out to our founders and saying, what's the progress on your company? We always like to see, if not monthly, then quarterly updates from the entrepreneur. It helps us keep track, but it's also just best practice, honestly, as an entrepreneur, to update people in your ecosystem of how things are going. On the income share agreement side, we do have a servicer that we use. So they, monitor income, collect payments, ensure compliance, everything there. They're experts there. Company called Meritas, and so we just let them we use them for our income share agreements. And then on the equity side, just like any other traditional early stage investor, we're just tracking the portfolio and trying to stay up to date on how those companies are performing.
Got it. And on the Chisos side, I read that this CISA even is on flexible terms, right? So it isn't even solid terms that, okay, these are written down in paper. Now you have to follow them no matter what. So even these are flexible, right? So what is this flexibility about?
So the language about the flexibility is more just about the income share agreement. So instead of rigid monthly payments with interest no matter what, like traditional credit products, our income share agreement is flexible. It's, if you make $10,000 one month, then you make a payment on your income share agreement. If the next 15 months you make $1,000 per month, then you don't make any payments. And so as you go through your entrepreneurial journey, or in the future as you are an athlete or a YouTuber or Twitch streamer or an artist, you're going to have ups and downs in your income. And so that flexibility comes in where the payments flex up and down with your income, and even go to zero if your income falls below the threshold. So there are a few pieces of the terms that we negotiate up front before we actually sign the contract with the individual. But that flexibility language that we're talking about is really just that up and down flexibility of payments based on income.
All right. And another term I saw on the website is the equity clawback. So how does that work? So it's basically the amount of equity that you're taking initially in the safe can be reduced later on, right? So how does that work?
Right. Yeah. So as I mentioned before, it's our convertible ISA is really made up of two instruments. One is the income share agreement. The other is the safe. There's two ways that those agreements interact. One is this equity clawback. So every time you make an income share agreement payment, whether it's required because you're making over the threshold, or it's discretionary because you're trying to hit the early prepayment, or just complete the contract, you're clawing back some of the equity owed to Chisos. And you can claw back up to 2/3 of that equity. So this is kind of a founder friendly, again, push and pull. Business is doing well, reduce ISA. Business isn't doing well, ISA comes into play. Example, we make, call it a $50,000 investment. Our initial safe says, as soon as this safe converts into shares, you owe us 3% shares. At any point until that safe actually converts into shares, you can make ISA payments and you can claw back, in this case, 2% equity, meaning Chisos will only be owed 1% shares. So that's where there's a little bit of it's up to the founder to decide what they want to do, because in say one specific case, we make that $50,000, 3% investment. The founder is going to raise, say, $5 million in a Series A round, and all of their safes are going to convert. At that point in time, they can decide, hey, I want to buy back as much equity as I can in a lump sum right now. And so they pay us back a lump sum. Or they can decide, hey, I'm just going to continue paying my ISA as required by my income level, personal income level, and let Chisos equity convert into shares. Typically, probably the math works out where they want to buy back as much equity as they can at that point in time. But yeah, it's up to the founder and how they want to play that. But that's how that equity clawback works. And then just quickly, the other piece, the way the safe and the income share agreement interact. If you are raising additional capital, and you raise over $3 million in a priced round of equity, we're going to say that's de-risking the company to a late seed, early Series A stage. And we're going to bring down the ISA repayment cap, which starts at 2x. We're going to bring that down to 1x. So you'll just owe 1x back on the income share agreement, or the principal only. And then us as an investor will take our risk holding the equity in the company. So that's the two ways that those interact.
Yeah. Yeah, I'm absolutely loving the model, and like it's absolutely brilliant what you've come up with. Besides the ISA, right? So this ISA, what percentage of the income is owed to you? If you can give us a sense of that, is that variable or
Mhm.
person to person, or is that fixed for everyone?
So it's usually 10%. In rare cases, we can move that around, but typically it's 10% income share.
And it's usually for a period of 3 years and can be reduced, right?
Uh, period. So max of 120 months of payments,
Okay.
or a 2x repayment cap is how that starts.
Mm-hmm.
Um, if an entrepreneur or an individual pays 1.5x within 5 years,
Mm-hmm.
then the agreement is complete. So kind of a incentive to pay quickly. Um, or yeah, the 120 months of payments. So that's the standard terms.
Got it. Got it. And let's talk about the entire investment process, like from the start to end, quickly. So, what's the step-by-step approach that you follow for while investing in an individual?
Yep. So quickly, step by step, we send everyone to our online application. It's open online application. There's a big orange button on our website. You fill out an initial form. Basically, what we're looking for there is, send us your pitch deck. Tell us generally where your credit stands, where your income levels stand. Give us your LinkedIn. Trying to just get a general sense of what the opportunity is. There are some thresholds where there'll be some automatics. Hey, you're not quite a fit for us, uh, and so those get automatically weeded out at that point. Um, you should most I think like 80% of individuals, especially, so we're only investing in U.S. citizens and permanent residents today. So that's another question we ask. Typically, after that form, you'll get a follow-up email that says, hey, please log in and fill out your profile. In your profile in our app, you'll fill out a little bit more information about your business, about your career, about yourself. Um, that'll give us enough information to dig in and say, okay, this deal seems like it's interesting enough, seems like it fits our criteria. At that point, we'll typically have a call with the individual, kind of an interview call. Hey, tell us about yourself. We'll ask some questions about your business. Um, Past that, we'll finalize our underwriting, maybe ask one or two more clarifying questions, but finalize our underwriting and get to a spot where we issue a term sheet. That term sheet, a little bit of negotiation on a couple terms there. Once that's signed, we can move to final docs pretty quick. Final docs signed, wire the money. All of that can occur, you know, in theory within 1 or 2 weeks. We're moving a little bit slow right now. Um, we've been doing deals in, call it, 2 to 4 weeks, but that's the process on how we're underwriting.
Got it. And a follow-up question to something you mentioned earlier in this episode about the clawback, right? So, isn't the clawback slightly against the investor interest? Because if the company is doing well, ideally the investor would want more share in the company, right? But you're offering a clawback there. So, does that not go against the investor interest?
So it's the middle ground that we've struck between founder interest and investor interest.
Mm-hmm.
So, when we're coming in and making an investment in the person, super risky. Typically, it's really early.
Right.
Uh, there's some other edge cases where we're a bridge, but typically it's super risky. And so, any most people are not going to be investing directly in the company only,
Mm-hmm.
company equity only. That's why we have the income share agreement. That is our downside protection. That provides us some cash flow. And if we look at the stats, you know, a not insignificant number of very early stage companies don't end up panning out.
Mm-hmm.
And so for us to be able to provide that capital at that stage, we need the income share agreement with us. Now, we also realize that as an investor or as a founder continues building their company and has some success, that, you know, we don't want to be on the cap table for, let's say 3 or 4% when we only put in $50,000. And so that's why we put in the clawback mechanism, so that the founder can reduce that equity owed to Chisos, reduce their own dilution. But they still got that money in the beginning. So that's why we still have that residual piece, so that if they create, $1 billion company, we'll still have some equity ownership. So it was a process of kind of give and take, where we wanted it to have some founder friendly features so that our capital would be attractive. But as an investor, we also need to have some type of risk-adjusted return that makes sense for us to raise money and to deploy that capital. So that was kind of the thinking on why we had that equity clawback mechanism in place. The other piece is, in order for an equity clawback to occur, we're getting paid on the income share agreement. So it's not like we're just kind of giving that up for free. We're getting paid back on the income share agreement. So we are returning money to our investors.
Right, absolutely. Yeah, and I absolutely love the balance that you've struck between investor interest and founder interest. Absolutely love that and really appreciate that. So, moving on to my last main question before we move on to the rapid fire round, and that is about the value add. So, once you have invested in these individuals, how are you trying to help these individuals succeed as entrepreneurs in whatever they're doing?
So far we have 32 investments. Relatively small portfolio that we can have some hands-on experience with. So, a couple different examples. We bring everybody into a Slack channel where we have resources and perks, building out a mentor advisor database, people in our networks and people that we've met that are willing to help founders, trying to make those connections. Investors is another one. We have investors in our network that we try and intro the founders to. So everything around money and mentorship and advisorship. We are also having office hours and we're having webinars. So we'll find somebody who's really good at marketing or who's really good at determining how to go about building your minimum viable product or developing, and we'll hold those webinars, and then the founders can attend, learn best practices, and then ask those questions of those individuals. Lastly, kind of the most hands-on thing we're doing is our team has some expertise in just fundraising processes, structuring a deck, thinking through business strategy at the early stages. And so we'll have one-on-ones where we'll just meet for 30 minutes to an hour with the founder and brainstorm with them and provide them feedback. That is less scalable, but I think there'll always be an element of that where you get that kind of hands-on one-on-one conversation with part of the Chisos team. And I think that's a valuable piece for founders, because information's everywhere online. You can go Google search anything. A lot of YC Startup School has some great resources, but talking with a person and really trying to flesh out your idea and your strategy is on a totally different level of helpfulness than just kind of watching a video, at least in my experience.
Yeah, absolutely agree to that. Yeah, that sounds good. So now let's move on to the rapid fire round, wherein I'll ask you 5 quick questions about the fund that you're investing via Chisos, and you have to give 5 quick answers. Works?
Okay,
All right.
works.
So the first one goes sectors and regions you invest in.
Sector agnostic. Regions is United States based. Capital efficient and scalable type businesses. So no brick and mortar bakery, but capital efficient and scalable.
Got it. What stage you typically invest in?
Typically pre-seed all the way to potentially a seed bridge.
Got it. And what's the typical check size?
Typical check size has been 40,000. Ranges though anywhere from 15 to 50,000.
And where can founders and potential founders pitch you?
Online, chisos.io, chisos.io. We have a application, open online application that you can start.
Great. Last one, where can our listeners follow you?
So Twitter is a good one, at WD Stringer or at Chisos Capital. LinkedIn, I think the same. And then I'll throw an email, hello@chisos.io. You can send us an email and we'll get back to you. We're pretty easy to find just through the socials and on our website.
Right. I'll make sure to plug all those links in the show notes below so that our listeners can get there easily. Thank you so much for coming on. It was great talking to you, and I love what you're building. And this is certainly something that's needed. And we don't really see so much innovation happening in the VC ecosystem. So this is really welcome. I really appreciate you doing this. Thank you so much for coming on, and happy investing.
Yeah, cheers. Thank you for having me.
Yeah, my pleasure.